Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So if you are like me, you are always looking for a company to invest in that is undervalued at that point. And what I'm going to share with you guys today is one single undervalued stock that's in the technology sector, okay, and that's growing their earnings double digits. When you look at the S&P 500 right now for the last 3 months, you might look around and think there is nothing to invest in because majority of the companies, especially high growth companies, have gone up so much, which is actually the truth. But there are a couple of companies that have not done that. If you want to buy, obviously the other companies, for example, other sectors, that the healthcare and the energy, whatever, they are down a bit. But when you look at the technology companies, 50 something percent, 17%, 16%, okay, 25%, and so on, you might think, you know what, there's nothing I can actually add to my portfolio. But fortunately for us, is actually that's not the truth. Okay, so there are great companies out there that have gone down quite a bit, and we could potentially add to our portfolios. And one of those companies is the Autodesk, and I'm going to talk about that in a second. But before we do that, please join us on the Discord. If you haven't joined us already, you can go and join us on the Patreon. Okay, you get basically access to all of these spreadsheets as well as the Sharia compliant investing ebook, and join us on the Discord, inshallah. Right, like I said, the company that we're going to talk about today is Autodesk. This is a technology company. They work with three different basically industries. For example, they work with architects, engineering, and construction companies, which is like, if you basically from Middle East side of things, from everywhere around the world, China, Middle East, whatever, there's so much construction and stuff going on, and they use the software this company creates. Design and manufacturing, and media entertainment. So these are the three basically sectors they work with. Now, when it comes to their revenue side of things, okay, they have a recurring revenue. From 2013, their revenue came from the recurring revenue was about 41%. Right now, we're looking at about 98%, which is absolutely huge. What this means is you basically sign up, just like Netflix. You sign up and you basically stuck with them. And the good news for this company is it's very hard to change once you've actually are in their environment. Because if you're a construction company and you bought this software for the next 5 years, you stuck with the next 5 years, and then once that's finished, obviously you're familiar with it, it's hard to change. And there's not a lot of companies out there that have this similar sort of software, and this is a reason why I actually really like this company. And the remaining performance obligations, meaning basically once you're in it, is very hard. So some companies have signed up for 5 years, so for the long term, and some are basically current remaining performance obligations. So they just have it for now, but they could potentially basically add to it. In terms of resilience, subscription foundation side of things, in 2008, when the global financial crisis happened, okay, their revenue from there just declined quite a bit, but it's bounced back now to the levels that it was. And since the pandemic, for example, so a lot of the companies that were using their software, okay, at the time, obviously opted out or whatever. But since the COVID happened, it's actually they stuck with it. So they haven't actually, not much has changed, and it's bouncing back to the levels that it was. So that actually is quite good news. The other good news about this company is basically is around the globe. So it's not even just based on just US and so on. They have customers everywhere around the world, and their software, okay, the product family is actually, they have loads of different types of software that these companies use. So they're not relying on just one single product. The other thing as well is basically the revenue comes from basically loads of different customers, and the size, for example, they have a large companies they work with, about 40%. They have small companies, about 14%, and 46% comes from like a medium-sized businesses. Okay, so they're very, very well diversified. And the final thing I want to show you about their presentation, this is their presentation from on their website, is 2008 to right now 2023. The revenue has been growing every single year, which is absolutely amazing to see, right? Every single basically year they have been increasing that. And so there's a lot more information that you can return to capital shareholders and so on. So there's a lot more information you can look at about the company and what they do. Just go to their website. But what I'm going to do now is look at the financials. Okay, is information technology, company name is Autodesk. Basically current price is $203 per share. A year to date performance is about 9%. The 5-year total return is basically 5-year return is basically almost to 51%. EPS $3.86. So this company is actually has a positive EPS, so they're not basically your type, your high flying companies that are still not making any money. This company does make some money. Okay, market cap is $45 billion right now, so they're not a huge company, but they're actually kind of medium sized. Wide economic moat. Okay, beta is actually slightly higher than 1, and when you look at the PE, you're like, whoa, that's very expensive in comparison to the sector, in comparison to the S&P 500. But the forward PE is basically about 29, and the 5-year average was 67. So this tells me it's actually cheaper than where it has been in the last 5 years. Price to free cash flow right now looking about 20, and PEG ratio of just above 1. So this tells me it's actually slightly cheaper. But obviously, when you look at the current, it is still expensive, and there is a reason why it's expensive, and I'll show you that in a second. Because what customers are doing, basically what investors are doing, is they look at the growth of the projection for this business and say, okay, it's worth that much. Okay, that's basically what it is. Free cash flow, we're looking about $2.3 billion. Free cash flow margin, we're looking about 38%, and free cash flow yield of almost 20%. Way more than what we're looking for. Profit margin 16%, operating margin of 19%, return on basically equity 91%, which is absolutely huge. Total return in the last 10 years, we're looking about 20%. Return on invested capital, we're looking about 25%, and revenue growth in the last 5 years, we're looking about almost 20%. Current ratio just below 1. That means basically the company might not be able to pay off their might not have enough liquid to pay off, but the fact that their liabilities, but the fact that they've got a bit of a free cash flow, that should help the company. This is one of the reasons why basically investors are betting on this company to actually do well. 15% expected. The growth estimates for next year is 15%, then almost 15% every single year. So this double-digit growth is basically why investors are paying a lot of money. According to Simply Wall Street, is undervalued about 8% right now, so their price target is 223. Right now it's about 200. According to Morningstar, it's about 15%, so $140 per share is basically what they're expecting. Top rank is about at least 13% upside, $230 per share, and same goes for Seeking Alpha. And according to Seeking Alpha, it is a buy right now. In terms of business side of things, it's actually 100% side of the business activity side of things. Interest bearing 5.7, and interest bearing securities just about below 5%. And when it comes to the shares outstanding, as you can see, they have been buying back their own shares. Now quickly, let's just look at Seeking Alpha, and if you go to the ratings, what you will notice is Seeking Alpha ratings, okay, is actually a buy, Wall Street is actually a buy, and Quant is a buy. There's not that many companies that where all three analysts actually basically agree on this is a buy company right now. And like I've already shown you, and according to Seeking Alpha, it's about 13% upside from where it is. Couple of more things to show you. If you look at the revenue growth, okay, as you can see, it's heading the right direction in terms of EPS as well. So if we look at the annualized and take out the estimates, as you can see, it's heading the right direction. So from $1 to right now, basically 22 and 23, they're expecting about $6.63, which is absolutely huge. 2019 was basically about $1, the actual, and 2023 it was $6 and so on. And then when you look at the estimates, right, if we include that, they're expecting the 2025 to be about $8.36. So this is the reason why a lot of investors are basically expecting the fact that they grew from 1 to almost 8 in about a space of 6 years or so is absolutely huge. If we include the revenue as basically take out the estimate, you can also see from $2.5 billion of revenue to basically doubling in 5 years. If they can continue doing that, I don't know if that's possible, but if they can continue doing that, that would be absolutely amazing. And if we include the estimates, as you can see, this year is 5.1 billion, so 5.01. The next one 5.541, and then $6.04 billion. So it is definitely heading the right direction. And finally, just to show you the EPS consensus estimates, for example, this year in 2024, they're expecting about 10% almost, then 15%, 15%, 15%, and so on. So if we just look at the first three, because that's the most analysts basically focusing on, but the rest of them are also a little bit decline here and there, but it's also majority of it is double digits. Same goes for the revenue, so 8, 11, 10, 12, okay, from $5 billion to in 30, about almost a double in that in 10 years, in 5 years. So which is absolutely huge. This is one of the reasons why I actually wanted to talk about this company today, because when you look at this, it's kind of like a little bit disheartening. But when you focus on this company, when you look at the Autodesk here, you can see it's actually 2% down since basically in the last 3 months, whereas everything else, companies in the same kind of sector, like for example, companies like ServiceNow is up 21%, okay, but this company is actually down quite a bit. So I wanted to share with you guys this company. There's not that many companies that are undervalued at the moment in the technology sector, but that's one of the companies that are down right now. I wouldn't be adding this company to my this portfolio, but it's on the watch list for the family portfolio, inshallah. And when I do it, if I ever do it, then I will let you know, inshallah. Again, do your own research, find out a bit more information about the company before you ever invest. And if you can join us on the Discord, that will be really helpful. It does definitely help the channel. Have a wonderful day. Assalamu Alaikum.